Have you ever opened the fridge just to stare? Not because you're hungry, just checking to see if anything magical has happened in there since the last time you looked. Like maybe the yogurt's formed a choir, or the leftover pizza finally achieved self-awareness. No? Just me? I'll just skip to the punch. Publicly traded real estate stocks experienced a significant decline as a direct result of President Trump's new global tariffs on goods entering the US. This broad downturn saw the equity REIT index fall 2%, with particularly sharp drops in hotel REITs around 8% and in industrial REITs nearly 7%. These tariff actions have sparked concerns among experts about a potential global trade war and its risk of negatively affecting the US economy, possibly leading to a recession. It seems like Trump's global tariff spree served as an unexpected demolition order for real estate stock values. Wall Street reacted with unpredictable alarm, sending hotel REITs tumbling, perhaps anticipating fewer tariff-burdened tourists checking in, and hitting industrial REITs, likely because warehouses are less thrilling when global trade hits the brakes. While European property stocks seem to shrug nonchalantly, their American counterparts got a swift lesson that sparking a potential trade war may not be the best effective strategy for boosting domestic property portfolios, no matter how great the intentions sound. Federal Reserve Chair Jerome Powell warned that the recently implemented tariffs are expected to lead to higher inflation and slower economic growth than previously anticipated. While acknowledging the economy was in a good place at the time, Powell indicated that the central bank would monitor the effects of tariffs and potential retaliatory actions like those taken by China before adjusting any monetary policies. Potential negative consequences include increased unemployment, difficulty reaching the Fed's 2% inflation target, higher construction costs, and potential impacts on housing labor due to immigration policies. It's always a confidence booster when the nation's top banker essentially confirms that, yes, those tariffs are indeed poised to act like a inflationary gremlin, significantly larger than expected. But the official plan is to wait and see how badly things will actually get. However, amidst these challenges, some potential silver linings can be noted. The tariffs were seen by some as a catalyst that could accelerate the reshoring manufacturing back to the US, and the shift could potentially boost long-term demand for industrial properties like factories and warehouses. I don't know, something about a double-edged sword. And responding to new Trump administration tariffs, China will impose a matching 34% duty on US imports beginning April 10th, escalating ongoing trade disputes. While a brief grace period exists for goods shipped just before the deadline, Beijing also announced a new export controls targeting rare earth materials and specific US entities alongside addition to its unreliable entity list. China frames these retaliatory actions as a necessary response to US tariffs and that it violates international trade rules and harm its interests. This is like the global trade equivalent of, I know what you are, but what am I? They hit reply all so fast, they probably had this response warmed up in the drafts folder. Moving on from tariff news, Hooters has filed for bankruptcy as part of a strategic shift towards a franchise-based business model. To ensure restaurants remained operational during this period, a group, including the chain's founder, plans to acquire the 151 company-owned locations in the US. The company is also undertaking a rebranding to cultivate a more wholesome atmosphere by moving away from events such as bikini nights. CEO Neil Kiefer said that the transition to a pure franchise model aims to streamline operations and support sustainable long-term growth. Apparently, the secret ingredient wasn't in the wing sauce. Hooters is filing for Chapter 11 bankruptcy protection, signaling that perhaps the business model relying on orange short shorts and double entendres finally hit its expiration date. Their bold recovery strategy involves selling off company stores, which is conveniently going back to a group including the founder, and embarking on a quest for wholesomeness, a move that feels about as natural as putting A1 sauce on a fine steak. Plans are advancing for Meta's record-setting $10 billion AI data center in Holly Ridge, Louisiana, a massive 4 million square foot facility expected to generate substantial local employment through approximately 500 permanent and 5,000 construction roles. While representing a significant economic development for the region, the project has also sparked considerable scrutiny regarding its long-term impact, particularly concerning resource allocation and financial risk. Central to these concerns are Entergy's related $3.2 billion investment in a new natural gas power plant, essentially required for only Meta's anticipated 15-year operational period. And the data center's enormous projected electricity consumption estimated at up to 15% of Louisiana's current power generation capacity. It's certainly a bold move to welcome Meta's $10 billion AI data behemoth, roughly the size of a small nation, and demanding 15% of your state's power grid, all while crossing your fingers that their definition of a long-term commitment extends beyond the lifespan of a typical tech trend. Promising hundreds of jobs is great PR, but when it requires potentially building billions in power plants that might outlast the tenant, you have to wonder if Louisiana is getting a state-of-the-art tech hub or just volunteering to be the incredibly expensive home for AI's notoriously large appetite. Part of a largely abandoned Bay Area entertainment district project in San Jose is now being considered for a data center complex. The original developer has planned a mixed-use development called Shops at Terra, including hotels, retail, and Topgolf. But only the Topgolf facility was completed. Now, the developer is proposing a 2-building data center on a campus of 9.3 vacant acres of the site, totaling 462,000 square feet, which includes a data center and an emergency supply facility. This follows a smaller data center proposal floated by the company for the site in 2023. So, the grand vision for a bustling Bay Area entertainment district features hotels, shops, but ultimately delivered a Topgolf and potentially a massive data center. It seems that digital revolution has officially replaced retail therapy, and hospitality is the highest and best use for prime vacant land in Silicon Valley. Forget enjoying drinks after practicing your swing. Soon, the ambient noise might just be the gentle hum of servers storing our collective online existence. Manhattan's office market experienced its most active leasing quarter since 2019 in the first quarter of 2025, driven significantly by large tenants expanding or upgrading their spaces, which helped lower the overall office availability rate to 17.7%. This surge, marked by 16 deals exceeding 100,000 square feet each, showed particular strength in high-quality trophy Class A buildings, where availability dipped below 12% and average asking rents topped $85 per square foot, especially in desirable areas like Hudson Yards. Well, it seems the more rumors of Manhattan's office demise were greatly exaggerated. Landlords across the borough must be breathing a collective sigh of relief, as leasing activity partied like it was 2019 again last quarter, fueled by big companies deciding that maybe those commutes aren't so bad if the destination is a gleaming trophy tower. While an availability rate still sniffing around 18% isn't exactly tight, the mad dash for premium space suggests the new mantra isn't just location, 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 but location, luxury, location. Trump has established a new office called the United States Investment Accelerator to oversee the CHIPS Act program, which aims to boost domestic semiconductor manufacturing. This new office is intended to streamline regulations and expedite the permitting processes for projects involving over $1 billion in U.S. investments. Alongside this, Secretary of Commerce Howard Lutnick is reportedly considering changes to the CHIPS program's implementation, which might involve incentivizing companies to increase their investment levels to secure funding or possibly altering previously arranged award payouts. Apparently, the CHIPS Act needed its own accelerator pedal, so the Trump administration has created the United States Investment Accelerator, presumably to make billions in semiconductor subsidies move faster than molasses in January, or at least faster than standard government processes. While this new office aims to slash red tape, Commerce Secretary Lutnick is reportedly considering his own form of acceleration, potentially holding awarded funds ransom until companies promise even bigger investments. It's a fascinating approach, streamlining permits with one hand while possibly renegotiating signed checks with the others, proving that in Washington, even accelerating can take a scenic, slightly unpredictable route. And that's all the real estate news for this week. If only we had an accelerated pedal that could bring us next week's news right now, then you wouldn't have to wait so long. The only caveat being if you had one of those time fast forward remotes, but you don't, so maybe just get subscribed, and I'll see you soon.